My name's Gordon Clark. I'm a professor at Oxford University. I'm also a visiting professor at a number of universities in the rest of the world. For example, Monash University in Melbourne, but also Stanford University. My expertise is generally in financial institutions, decision-making, governance, management. I'm also very much interested in individual decision-making, both within an institutional context, but also with respect to people's own savings behaviour. And in that respect, I'm a social scientist. I was trained as an economist, but I am very much interested in structure and organisation of an institution, as well as what drives individual behaviour. I don't think of a sovereign wealth fund as having any particular vices or bad aspects. I think a sovereign wealth fund in general provides some positive elements to financial markets. If a sovereign wealth fund is well governed, it will have a long-term commitment to investment. In that respect, it should provide liquidity in adverse situations in financial markets. I also think a sovereign wealth fund has the capacity to make a type of investment that many asset managers are unlikely to make, for example, in long-dated securities or in investment opportunities that don't have as much liquidity, in investment options that are really at the technological frontier. So in that sense, a sovereign wealth fund is a different kind of investor than a conventional asset manager or even asset owner, such as a pension fund. So they have those virtues. And I think it's important that classes of investors look to the future as opposed to being incredibly short-term. And I think it's important that a sovereign wealth fund provide that kind of depth to financial markets and the investment process in general. Let's assume an investment manager works for a client, say an asset owner. An investment manager is more often than not judged by their quarterly, yearly returns. That inevitably makes them more short-term than long-term oriented. Often the client will like the liquidity offered by an investment manager, the fact that you can trade in and out of securities and have liquidity available if the asset owner would like it. So in that sense, many investment managers are hostage to financial markets in terms of returns and are hostage to the preferences of asset owners. Not all investment managers are like that, of course. Some have long commitments, but often in specific asset classes such as private equity, infrastructure, and the like. If we turn to asset owners come in many shapes and sizes, of course. Those in the defined benefit space, of course, are very self-conscious of liabilities. And in some countries, the regulatory framework makes an asset owner very conscious of the yearly match between assets and liabilities, or in the UK, for example, every 3 years, that's a significant consideration. So in that sense, a defined benefit asset owner has at best a 3-year or 5-year time horizon, notwithstanding the fact that their liabilities might stretch out to 80 years. So in that sense, an asset owner is often going to be relatively short-term oriented. And as I say, demand from an investment manager a level of performance and a level of liquidity that is more short-term oriented. So then when you look at a sovereign wealth fund, many sovereign wealth funds don't really have a liability. or if it is, it's a notional long-term liability which is often unquantified. They have a mandate to invest long-term. And maybe their assets will be called upon by their sponsor sometime in the future, but oftentimes that future is a receding future rather than a near-term future. So in that sense, they have the advantage of not having to mark to market. They're not having necessarily to match up assets and liabilities. They can pursue a 5-year, 10-year, even 20-year investment strategy. Although I must say, I've not met many sovereign wealth funds that have a 20-year time horizon. I've certainly met them as they talk to me about a 5-year, 10-year horizon. Final point to make is, inevitably though, what's available for a sovereign wealth fund to invest in, often it's global securities of one form or another. Often they're going to be responsive to market movements. As I say, they could be counter-cyclical. They could counter, if you like, movements in markets. But then again, you know, it'd be a brave sovereign wealth fund that reported to Parliament that they'd lost a ton of money as the market slipped into a catastrophic decline. It's a brave sovereign wealth fund that reports liability, or rather reports declining returns, and then says, trust me, in the future it'll all be okay. So there is that consideration as well. Let's begin by distinguishing between different classes of sovereign wealth funds. Some sovereign wealth funds are effectively stabilisation funds. They provide insurance for governments in the case of shortfalls in revenue and long-term spending commitments. So in that sense, you could have a sovereign wealth fund that was a stabilisation fund that was counter-cyclical in a way, but its time horizons not that long-term. They might be as long as the business cycle in a gross sense globally, which might take it, 3 to 5 to 7 years out. And they're there. Their purpose is basically to fill in shortfalls of government revenue where governments have made substantial commitments of spending in the future. And you can see those types of funds around the world where, particularly on spending on health, education and welfare, are long-term commitments of governments, and yet revenue is relatively short run in terms of the flux and flow in revenue. So a sovereign wealth fund there has to be very conscious of the purpose of itself in relation to the government sponsor and actually manage or structure an investment strategy that takes into account that. There's another class of sovereign wealth funds, of course, which is less about stabilisation, and it is more of a saving vehicle for the wealth of the nation. Saving in the sense that, for example, natural resources will run out one day, oil will run out, coal will run out, gas will run out, and that it is in that sense a savings vehicle. So what you want to do in a savings vehicle is at least maintain the real value of the savings. So it's a capital preservation plus inflation hedge, plus it is a premium on the rate of return that might otherwise be found by investing in infrastructure or physical assets of the country. So you could imagine it's capital preservation, premium on inflation, and a premium on the economic rate of return available in the economy as a whole. Now that looks to me to be a 5-year, 10-year proposition. Might be longer, but as I said before, a sovereign wealth fund struggles probably to think 20 years out. It's just in the nature of how you structure an investment program. It's difficult for anybody to structure one that has a payoff that far into the future. But for example, if you invest in infrastructure worldwide as an investment class, infrastructure could last 50 years, 100 years, although most investors look at a 20-year horizon for infrastructure, if that's how far they look out. Then there's another class of sovereign wealth funds, which is increasingly called a sovereign development fund. They, if you like, hold the assets entrusted to them by the government. They have the expertise necessary to make long-term investments, but here it's in the infrastructure of a country, it's in its capacity, if you like, capabilities and resources. That's what it's investing in. And in that sense, it's close to the government, but at one step removed, because the assumption is the sovereign wealth fund has capabilities and resources not otherwise available in government. For example, the central bank typically doesn't have those types of resources, capabilities and resources. So that a sovereign development fund is a hedge on the future in a very significant way, and it's aimed at actually underwriting the economic potential of a country. And that again gives you a very different investment strategy. It might not be in financial markets at all, actually, except in a kind of how you manage the flux and flow of assets under management. It's no good having them all sitting in a bank, for 6 months and 12 months at a time. It's important to make money earn its way. So in that sense, its investment strategy is quite different from a stabilisation fund. So that's so far 3 classes of sovereign wealth funds. There are other sort of classes of sovereign wealth funds, that some of which are just sheer portfolio investors. And that class is typically sort of established, built 10 or 20 years ago, when there was a massive sort of outrageous confidence in the future of financial markets worldwide and the virtues of portfolio diversification through publicly traded securities. Who now has that level of confidence, I wonder? There's a complex array of issues in the question. First question is, or first dimension of the question, I suppose, is how do you measure the performance of the fund? If you're measuring it on a quarterly, annual basis against a benchmark, which is, let's say, the global portfolio of all traded securities, then inevitably your investment strategy is going to be tailored to that goal in relation to the instruments or measures of performance against that goal. And that could basically produce a sovereign wealth fund that is a global portfolio manager that matches as much as possible through its selection of stocks and bonds and other instruments the path of the global financial market system. The great virtue, actually, though, of the Norwegian fund is that it was and has been able to invest against trends in the market. It does require some courage, as I say, to go to Parliament and say, look, we're losing money, but trust me, in the long term, it will all work out. But that's what happened through the global financial crisis, and I think Norwegian Parliament and everybody concerned learned something from that. But if how you set the target rate of return is distributed over a much longer period of time, so your target rate of return is, let's say, 4% real on average over 10 years. Well, at this point, does it make a lot of sense to be investing in short-term stocks and bonds and following or going counter to the path of global stock markets? I don't think that sounds a very sensible strategy, because you have to look into the composition of your portfolio and now start and pick out those sectors, those firms that are going to be long-term performers against that time horizon. And you may find, for example, that some sectors and some types of firms are simply not going to be good performers or effective performers over a 10-year period of time. That means you might actually have to think of restructuring your portfolio for and against your expectations of those sectors that are going to perform well and those sectors that are going to perform poorly. There's no good being, over the long term, 10 years, in a sector that systematically underperforms. So in that sense, when people start talking about sustainable, that is environmentally sustainable sectors and firms and organisations, I have a lot more interest if the time horizon is 10 years, where actually it's the composition of the portfolio that's key to how it's going to perform, not, the short-term path of the global stock markets. And in that sense, I think there's a lot of debate about the future path of the global economy in relation to those sectors and industries that are going to be consistent with environmental sustainability and those that are inconsistent with environmental sustainability. And in part, just at the moment, the debate is centering on the coal industry, the global coal industry. And you can see a fair bit of movement going on, both in the providers of coal and the investors in coal, about actually what are coal's prospects in 10 years' time. And I must say coal's prospects are poor in the long term. It's not only CO2 emissions that's at issue, it's the fact that there are going to be other sources of energy that are going to basically, as they come on stream, are going to discount the value of coal. So the question here is, what should your coal portfolio be? Not just now, but in 5 years and in 10 years' time. And there's reason to take seriously that composition effect in your investment strategy. Sovereign wealth funds are a distinctive entity, different from a private commercial long-term investor in this sense that a sovereign wealth fund often embodies, particularly in democracies, the culture, values and objectives of a whole society. I say particularly in democracies. This isn't don't take my statement as general to all sovereign wealth funds, because some sovereign wealth funds do not embody society's cultures, values or objectives. And in that sense, those sovereign wealth funds that are embedded in democracies are more self-conscious about actually long-term objectives at one hand, but also how they meet society's values, goals and objectives. Now, that comes in two forms. Parliament could tell them, Parliament could tell them, you can't invest in this and you can invest in that. And the Norwegians, for example, use an ethics committee to screen out select numbers of companies. But it's a very, very intensive process of analysis and deselection. So Parliament could say, don't invest in that, invest in this, and actually that's an entirely legitimate expression of a society's values and objectives. And a sovereign wealth fund, I think, by its very constitution, has an obligation to match up against those objectives, its own activities. But oftentimes democracies aren't good at entirely specifying precisely what it is that its institutions ought to achieve in terms of long-term values, objectives and the like. And in that respect, boards of these entities are often required to make their own judgments about what's consistent with society and what's inconsistent with society. And oftentimes parliaments basically devolve to boards the responsibility for making those judgments, subject to the caveat, of course, that parliaments might trump them when they do those things. So in that sense, it's oftentimes a little bit more complicated than I just described, where boards actually have to make those judgments. And then from boards, they have to basically get their professionals to execute those types of plans. And I do think all kinds of democracies sort of use boards for that kind of purpose, and justifiably so, because it may be that Parliament is unable to actually specify in any sort of meaningful sense investment goals and objectives and judgments about what's proper and otherwise, and they may properly devolve that to boards. And I again think that that's entirely consistent with the fact that a sovereign wealth fund ultimately answers either directly or indirectly or explicitly or implicitly to the society that it is sponsored by. Before we go there, let's go back to the question you asked about sustainable investment. So a sovereign wealth fund that has a long-term investment mandate that is self-conscious about the values and commitments of society might find actually structuring its portfolio over the long term, for example, in favour of sustainable investment, is simultaneously consistent with their investment mandate and with the goals and objectives of society. So in that sense, as you sort of pointed out before, there are instances where these things are entirely consistent one with the other. And indeed, knowledge of long-term environmental trends and consequences may be actually useful in integrating into long-term investment strategy a concern for those issues. And you may actually benefit in a way that a commercial entity not taking seriously those issues may entirely miss that type of opportunity. So then you're asking about whether boards making those decisions may nonetheless be subject to adverse pressures or influences. Well, quite clearly, any board in any organisation is going to be subject to pressures. Any board member in any organisation may actually pursue their own objectives, either explicitly or implicitly often, to the detriment of the whole organisation. So the first point to make is who's appointed to boards, what skills they bring, apparent, not so apparent conflicts of interest must always be taken into account when appointing a board member to any institution. And that matters for school boards, it matters for company boards, and it matters for sovereign wealth fund boards as well. So don't imagine that actually when we talk about sovereign wealth fund governance or management, it's a special class. Now, you could say, of course, it's a ton of money, and that attracts a class of people often you don't want. It attracts a kind of a level of intrigue and corruption that, a school board is not likely to encounter. And I think that there's a lot of truth in that. There's a special responsibility, actually, that is placed on those that appoint people to this type of board to scrutinise, actually, what are the interests of board members. And I think it's fundamental, actually, because you could lose a lot of money, and when you lose such a huge amounts of money, you're kind of losing the future welfare of society. And in that sense, I think there's heightened scrutiny of appointments, and we must be quite transparent about people's interests in ways that actually give us confidence in the independence or the objectivity of board members. So that's, in a sense, by way of an editorial. That's what I think, how people ought to be assessed in those types of institutions. Is there corruption in the sector? Of course, there is massive corruption. But I think in some respects you have to see the corruption in relation to the countries themselves that are sponsoring the sovereign wealth funds. Some countries are characterised by corruption. Some countries are kleptocracies. That is, people are presidents, people are prime ministers of these types of countries precisely because it gives them access to untold wealth. Why would a sovereign wealth fund be any different from that? So, and you know, you don't have to go very far to find instances of countries being basically pillaged by its leaders because actually that's where wealth can be sort of accumulated in vast stores. And that's true of some resource-rich emerging economies, but it's also true of some established countries in parts of the world where democracy has proven to be incredibly fragile, or the military have proven to be the kind of the operating mechanism of governance. So yeah, so I think those are key issues. I think that's just a realistic view of the world. I know some people advocate a level of transparency and disclosure on a sovereign wealth fund that would have the world sign up to this a universal statement of disclosure and transparency. But I think that's unrealistic and wonderful if people do it, but simply in many cases a cover for basically corrupt practices. So I'm a realist when it comes to those kinds of issues. I sort of take two lessons from the recent history. One lesson from recent history, that is global financial crisis, is that actually the boards of large financial institutions have to be scrutinised for their composition, for who's on them, their skills and expertise. You know, I think we've learned a great deal from the global financial crisis that boards that are amateurish, boards that are poorly qualified, lose money hand over fist, and they may well actually make perverse decisions in their own favour. But actually the lesson learnt here is actually take these boards very seriously indeed. And I must say that lesson's been learnt around the world actually. So you see in the central bank in the Netherlands much more interest in the appointment process and the skills and qualifications, and that's as it should be. I think the second big lesson that's been learnt in recent years is that looking forward, that is how you structure and design an investment strategy, is going to be very different than what it was in the past. You know, I don't think many people look to the future with the same confidence they might have done so, say, 15, 20 years ago, when modern portfolio theory, efficient markets, these types of fundamental assumptions were taken as fact rather than a supposition or an intellectual edifice. So I think, you know, looking forward, you can't look forward with a great deal of confidence in efficient markets or indeed the virtues of modern portfolio theory. Not to say that they're wrong in any sort of fundamental sense. Quite clearly they come out of an intellectual tradition that is extraordinarily well developed. But actually as a recipe for investing, a simple recipe for investing, I'm afraid they're not going to do it for anybody. And that reality must sort of then inform the framing and development of investment strategy that goes well beyond simple assumptions. And that means skills, expertise, that means investing in the governance and management of financial institutions in ways that hasn't been done before. Pension funds, sovereign wealth funds come in many shapes and sizes, particularly sizes. So if you're a pension fund, less than, I don't know, 5 billion or 10 billion pounds, your capacity to invest in knowledge, information that can beat the market is pretty marginal. And so a small fund, I call a fund with less than 10 billion pounds small, perhaps that's a bit bit harsh, but nonetheless, a small fund is unlikely to have the capabilities and resources necessary to play the game in investment with the depth and the sureness of touch that really big funds might be able to do. And in that way, they're going to have to look for ways of investing that are going to economise on the resources needed, that is nonetheless going to protect them from adverse results. So I think in that sense, a small fund is going to remain actually very much dependent on the global financial services industry, and probably rightfully so, because the costs of doing otherwise are so large. A large institution, paradoxically, carries certain burdens as well. You know, if you're going to be an informed investor, if you're going to sort of be at the margin of markets and the margin of investment opportunities over the long term, you know, it's fundamentally important to invest in governance and management capacity. Too often people say to me, look, the costs of investment are too high. We should be more efficient. We should be more economical in how we invest. Wow, really? In a big institution, you can make a hell of a lot of bad mistakes if you're cheap on the investment process side of things. So I think, you know, we have to get used to the fact that investment is going to cost more, particularly in bigger institutions, and the public must get used to the idea that actually that level of commitment and that level of assets in play demands actually investment in capacity. Many sovereign wealth funds are born and developed in economies that have relatively immature financial markets. So some governments think, sovereign wealth fund could add liquidity, could add capacity, trading capacity into the domestic financial market in ways that might speed up its maturity, speed up its growth and development. And that's a plausible strategy up to a point. But equally, a sovereign wealth fund in such a country could overwhelm actually the financial market itself, such that the investment decisions of the sovereign wealth fund come to dominate, if you like, the pricing of analysts of domestic stocks and bonds. And I think that's a real problem. Likewise, some countries have hugely developed financial sectors, institutions that are actually very large by global standards. And, you know, the Netherlands, Australia, Canada, New Zealand, you know, many of the Nordic countries, Scandinavian countries, they are instances where the financial institutions and the sophistication of financial players are very well developed. But if you deployed the assets locally, you know, you're just going to, all you do is really stimulate bubbles and asset sort of hurricanes, really, you know. And in that sense, investing locally can really distort the local market, and there's an obligation on those types of institutions to go offshore. And I don't think that's taken nearly seriously enough, to be honest. Partly because governments like the idea that, you know, institutions are underwriting the liquidity of local markets. They hate the idea that a local market might simply go away if assets were shift offshore. And I think, you know, there's a bit of nationalism caught up in the idea we have our own financial market. I think in many cases it's a very short-term and self-defeating idea. In the lead-up to the global financial crisis, there are a number of instances, particularly in the United States, of the political classes and the media being very anxious about a sovereign investor coming into notionally key infrastructure. it's there still actually in some resource-rich countries where a big sovereign wealth fund from another country might want to buy, a significant company that dominates, for example, one type of mineral resource or the like. But I think one of the great lessons of the global financial crisis is actually it's really important to have investors, whatever they are, and demonstrably it's important to have long-term investors, particularly in infrastructure. So I think the Americans learned two valuable lessons. Actually, sovereign wealth fund investment's good because it doesn't fly by night. It sticks with the investment, and because actually it can be relied on in the longer term to underwrite, if you like, the infrastructure itself. So I think that kind of anxiety, not nearly as obvious anymore. You do see it, as I said though, every now and again when a big sovereign wealth fund roaming the world looks at a relatively small country and a key company in, say, a key resource, and they think, I'd like that, and then actually what's often invoked are country-specific foreign investment review processes that try to balance the national interest against the need for investment. But of course that sort of tells a lot of the story, that actually a large country and a key resource in a relatively small country is often short of capital, and they need a long-term investor. They need actually the investment resources to develop the underlying resource assets. So in that sense, a sovereign fund is actually very important to them. It is notable around the world that that many smaller countries are financial assets short, and that's an impediment to their long-term development. I think on balance, through the financial crisis, the existence of sovereign wealth funds was positive. Whether it will be positive in the future, it's hard to judge. There are many sovereign wealth funds being developed at present, many. Most of them are relatively small in terms of asset size, 2 billion, 5 billion, 10 billion. A sovereign wealth fund of that size is, a pinprick. And does it really matter actually for either the financial markets in general, or for that matter for the country that develops a sovereign wealth fund? Sovereign wealth funds are increasingly a badge of modernity, a badge of development sophistication of a country that is trying themselves to have a global status and be recognized for its development potential. So in that sense, sovereign wealth funds are a badge of honor, perhaps less than financial institutions than people think. If an investment institution has a long-term horizon and a long-term return target, they must be very self-conscious of what are the motive forces about the long term, the economic forces. And one of those forces is actually resource security. One of those forces is climate change. One of those forces is actually the vulnerability or value of different types of industry sectors. So a long-term perspective is automatically in this space, and properly so. Proxy voting, institutional investors have to take proxy voting seriously. They must actually exercise all the instruments they have at hand to give voice to their expectations. A large financial institution has some responsibility to the vitality of financial markets themselves. I mean, large financial institutions can't look at the world as simply an opportunity set without taking some sense of responsibility for the health and vitality of that opportunity set. Now, granted, many financial institutions don't have sufficient size to do that, so they better join clubs that sort of gives expression to their long-term interest. So I think that's entirely proper and how it should be. I think in terms of sustainable investment, I am concerned when some larger institutions don't give expression to their longer-term interest, whether it be in annual general meetings, whether it be investing or disinvesting, or basically remaining silent about key questions. The concentration of financial power in large financial institutions is such that actually who else is going to give expression to those concerns, long-term concerns? Certainly isn't going to be the public, and governments have little understanding really of the area. Governments have little understanding of how financial markets work, let alone what the power and authority is of a large financial institution. So I do believe that financial institutions ought to be responsible investors. Climate change is the big issue of the 21st century. Climate change is the issue that is going to drive investment returns over the long term in specific sectors, in specific regions, right? If you've got a diverse portfolio, industry sector and geography-wise, if you don't take into account climate change over a 10 to 20 to 35-year horizon, you're going to be hostage, if you like, to the expression of climate change, whether that be in increased droughts, increased volatility of weather, and the like. I think any large institution looking to the future is really developing expertise in this space precisely because they know, if they're going to, for example, invest in water resources over the long term, ask yourself, where are going to be the water resources? They sure as hell aren't going to be in some areas of the world that currently have water resources. I have a lot of conversations as director of the Smith School of Enterprise and Environment with financial institutions, with large companies, with NGOs, with all manner of institutions that make up both national and global economy. And often that conversation is informed by a concern about climate change. When I have conversations with governments around the world, I get stories that come back that say, oh, look, the public isn't ready for it. The voting public isn't going to vote for it. We have, the start of an environment or climate change related policy, but we're concerned about the next election. Governments are very hamstrung on this issue at the moment because they're being asked to make a judgment about short-term interest balanced against long-term interest. And, companies are also being asked to make that sort of balance between short-term returns and long-term returns. But a government facing this sort of the clamour for short-term benefit over, an abstract longer-term benefit for future generations, almost always is forced back into the short-term benefit for current voters. I think that's terrible. I think that's irresponsible. I think it says nothing about our obligation to future generations, but it's the reality. Interesting, when I talk to a major corporation, major corporations, more than willing to talk about the long-term, short-term. They're more than willing to talk about where they see vulnerability in the longer term in terms of their business model, their reliance on resources, what markets are going to be viable or not viable. But for them, of course, to make an investment, a long-term investment like that, that is beyond the 3 to 5 year, 7-year horizon to the 10 to 20-year horizon, I would expect most of them think that they won't be rewarded for doing that type of investment. But that doesn't mean to say they're not conscious of it, or not even planning actually to situate themselves in the globe in a way that might actually benefit themselves. Because I do meet a lot of large companies that are very self-conscious of this issue. So that's the world we live in, Governments are compromised by the short term. Companies look to the long term but want investors to come with them on the journey. Investors are absorbed often with short-term returns. Some have a long-term mandate. They want to marry up with companies that have a long-term future. Well, that's a bit hard to do. So that's where we are at the moment. We're in a short-term, long-term world. But I do think companies and investment institutions have kind of more degrees of freedom at the moment to think and act long-term than governments. Sad. Any insurance company has to be very self-conscious about the frequency and intensity of storms. If you're insuring property on coast, properties on rivers that go into estuaries, into the sea, wow, Drainage systems, it's in this country alone, the drainage system is unable to cope with water runoff in intense storms. Maybe it was designed to do that, I'm not sure, but the combination of population growth, growth in urban space, the frequency and significance of storms are all contributing to overwhelming the infrastructure. And as you overwhelm the infrastructure, flooding occurs. Flooding basically floods property. Insurance companies insure property. They think, why are we doing this? Governments think, insurance companies might run away from insurance on these sort of vulnerable spaces. So they blackmail or they lock in insurance companies into insuring spaces they wouldn't otherwise insure. That's not sustainable. That's where we're going. An insurance company is very self-conscious of climate change. I think this is one of the points of emphasis I make about long-term investing. I could turn the argument around and say it's fundamentally important for humanity. And I do on occasion, but actually a stronger case can be made by linking it up to your investment strategy per se. And I take that seriously because that's actually people's responsibility on a day-to-day basis. And getting them to take it seriously means actually whole investment programs take it seriously. And as a consequence, market pricing starts to emerge in the market in ways that actually start to discount subtly, slowly, some sectors over other sectors. Good thing. Over the 20th century, social science, across all kinds of disciplines, assumed that individuals were rational, utility maximising entities that basically were self-conscious, either directly or otherwise, about their long-term welfare. And there's no doubt that that theory of behaviour and that theory of motivation is plausible up to a point. Plausible in the sense that I believe personally that people are fundamentally rational. I believe that people are self-conscious about their prospects, even if they may be somewhat seduced by the short term over the long term. And it's quite clear that that theoretical device, that theoretical explanation of individual behaviour is quite consistent with some financial interests that would have it that individuals ought to be the decision makers and ought to be basically the consumers of financial products, because the assumption is that being generally rational, that they ought to be responsible and would be responsible for the purchase of financial products about their future. So what I'm saying here is there is a theoretical castle, an edifice, that kind of gives weight to that idea. And there is an industry that would serve that. And sometimes the industry that would serve that argues the case for the individual to be taken seriously as the decision-making unit. And sometimes it's the case that social scientists and indeed politicians argue the case that people ought to be trusted to look after their own welfare, right? But that's counterposed, I must say, in recent years to an enormous revolution in the social sciences, led by people like Herbert Simon at Carnegie Mellon, Kahneman Tversky, astonishingly important behavioral psychologists who started with the premise, yes, people are rational. If you looked at it in gross aggregate terms, but people aren't always terribly competent or consistent in their decision making when they face significant risk and uncertainty. And in fact, actually, they show, as most behavioral psychologists show, that people are risk averse, loss averse, such that they would compromise their long-term prospects by an obsession with the short term and an anxiety over loss as opposed to prospects of reward that are distributed into the future. And this research program around the behavioral revolution and people's predispositions and their vulnerability in the context of risk and uncertainty, I think has changed how much of social science looks at individual behaviour and individual rationality. Yes, let's agree people are rational, but let's also see what types of environments they are effective decision maker and what types of environments are they ineffective decision makers. Let's not label ineffective as irrational. Let's just say, actually, given the scope of the nature of the problem they must solve, given risk and uncertainty that attains or obtains around those issues, they're not going to be effective decision makers. And if they're not effective decision makers, you can't rely on them to look after their own welfare in quite the way that we would rely on them if we assumed, like Model A, about people are rational, people are effective decision makers. So what we have now is really a collision between two different theories of behaviour. One theory, as I said, highly idealistic about individual rationality. The other one, much more empirical, much more informed about the realities of individual behaviour in the context of risk and uncertainty. And in that case, actually, in the case where people are subject to all kinds of behavioural biases and anomalies, where risk and uncertainty are important, you can't really expect us, that is social scientists, to believe that they ought to be fully responsible for long-term investing on their own behalf, particularly when products are opaque, particularly when payoffs, short-term, long-term, are unpredictable, particularly when actually they're subject to all kinds of influences that come with advertising, that deliberately or otherwise, basically shroud products from view from their underlying properties. So can people be as informed, as effective decision makers for their own welfare in the long term? I think most social scientists who are basically conscious of the behavioural revolution would say no. And that's a counterweight to those interested in financial markets and financial products who say, no, trust us, people. These calculating engines, they'll be fine, no problem. In fact, I don't think many of us who do research in this area think that people will be fine at all. Now, I must make two caveats to this. One is that people who don't have much in the way of underlying assets, people who are not particularly paid well, people whose incomes are relatively modest, often have relatively underdeveloped skills and expertise in making financial decisions. They're particularly vulnerable in this kind of environment. So why would you push on them responsibility for investing for their future when actually their investment decisions are so fundamentally important to their long-term welfare that there's no sort of background wealth that could ensure a poor decision? Why should we expect people who are already not terribly well off to take a gamble on the future? And I think that's a really important issue here. It's actually, how do we ensure the future welfare of a significant portion of the population that are neither equipped to make the decision nor actually capable of bearing the adverse consequences of a poor outcome? What about rich people? What about, the top 10 or 20% of the population that carry with them a fair amount of wealth, fair amount of expertise, a lot of experience? Should we equally ensure their welfare as we ensure the welfare of that other group I just talked about? In my judgment, probably not. They're not nearly as deserving for protection as I think that other group, much poorer people whose vulnerability to making a bad decision is so obviously significant. So I think really where the debate's going is actually, let's not ensure the whole population and their long-term welfare. Let's ensure those people who are most vulnerable. Let's leave those people who've got skills and expertise, who've got an underlying sort of resource base. Let's give them the opportunity to make their own choices, subject to regulating the providers of financial products, right? Ensuring that actually in some way or other we take a more deliberate responsibility for stability and structures of financial markets themselves. Let's actually give those people who may be equipped to make decisions, make sure that we provide an environment in which they make decisions that they're not going to be taken advantage of, either deliberately or systemically by the nature of the financial services industry. So I think that's where the debate's gone. And it all hinges on the fact that actually, in general, let's assume people are rational. In general, let's assume that they are capable of making decisions. But let's also assume that some environments, particularly those that are subject to risk and uncertainty, are often harsh environments. And let's also assume that in those situations, there are behavioural biases and anomalies that are in some sense self-defeating. Now, that being the case, let's not assume that that's true for all people, for all time, for whatever the circumstances, and that we have a special interest in society of protecting those that are most vulnerable to these situations. That's my take on the issue. There are political ideologies, philosophies, particularly from the 18th and 19th century, that place a premium on individual responsibility and volition. Liberalism is the embodiment of that, and it is a very, well, historically, liberalism and was a very empowering philosophy of society in general. So that's the historical legacy that we carry with us in terms of political philosophy and ideology. The premium on the individual, the premium on the person as a person who you can rely on to take responsibility. How else do we have democracies unless we assume that of all people? So in that sense, the thread that I'm talking about, social science thread, theoretical thread, and the political philosophy thread will remain there. I don't see that going away. What I'm saying is it's been balanced by this other thread that's come from behavioral psychology, which is more empirical, less about idealism, and it's pointed out actually the shortcomings of behaviour in certain types of environments. It's worth saying though, the behavioural psychology literature also shows that many people are very good at making decisions on an incremental basis where the environment isn't subject to massive shifts, massive unexpected shifts in structural performance. People are very good actually in their day-to-day lives. It's just that when you put them in a world in which they have to make decisions about futures that are very difficult to conceptualize, with products they find very difficult to understand, and an environment that is subject to risk and uncertainty like financial markets. So it isn't that people are just incompetent in general, that's not the story. It's the distinctive class of issues that you're asking them to make decisions about. That's actually the problem. I think it's going to bifurcate. We're going to end up with dual worlds. In the developed countries of the world, governments are going to basically increasingly insure or provide savings vehicles for those most vulnerable. So we'll have automatic enrolment systems, we will have mandatory contribution systems, we will have third-party investors that have a public purpose to them, like the UK Nest, but it's being reproduced around the world, that kind of instrument. And the other side of things, over and above the minimum, we will have regulation of financial products, financial industry, in ways that provides a kind of an environment in which people can take responsibility for making financial decisions over and above that minimum that governments will basically provide. That's what I think is going to happen. I think it's going to happen for two reasons. One is governments can't afford to insure the whole population. There's all kinds of reasons why that's the case, population ageing being one of them. But the residue of the global financial crisis means that governments can't. I think that's one reason. The other reason is the ideology of individual empowerment and individual responsibility will continue to be a thread. And I think it's very hard to say to somebody who's endowed with significant wealth, significant expertise, it's very hard to say to them, look, we don't trust you at all, we're not going to give you room to manoeuvre, when actually we have an ideological predisposition to give them that space. What we don't have is the capacity to rescue people after bad decision bad things have happened to them 20 or 30 years after the fact. And I think governments have realised we can't rescue whole sections of society. Sometime in the future where we won't have the resources to do it. So that's why we're insuring one group and allowing this other group to basically get on and do what they want to do within a regulatory framework. I think it does mean, though, that those people who do get on and do their own thing are going to have limited claims for redress if it all turns out bad. They're going to have to take responsibility for the adverse outcomes as well. Yes, a new crisis would give us a depression. It's arguable in Southern Europe there's already a depression. That is radically changing those countries, radically altering expectations, radically discounting the capacity of governments to basically save themselves, let alone their populations. So that exists parallel to a prosperous Northern Europe. Okay. Will there be another financial crisis? Well, as I read the situation, central banks are simultaneously injecting liquidity into financial markets so as to, if you like, sustain, rescue financial institutions and give them a path to the future. And that process of injecting liquidity carries with it significant dangers. It means, stocks have never been so good. I'm a trustee on a pension plan. I have my own defined contribution account, and I can see it's a remarkable success, like I haven't seen for 25 years in terms of, if you like, equity performance. It can't last, but as long as we have this level of liquidity, it's going to be a fact of life. So central banks are balancing rescue against actually the prospect of a bubble. I think we learnt a lot in the last 5 to 7 years, and you can see moves of central banks to try and dampen the bubble. That's the world we're in. We're in a dangerous world, but it's not as dangerous, I think, as it was in 2007. Now, some people interpret stock markets at the moment as reflecting major corporations' stocks of cash, that they've got a lot of investment potential, which is as yet unrealised. And there's some truth in that major companies are carrying a lot of cash. They're not investing that cash. Should they invest that cash, that would prompt actually tremendous economic growth, and it could, save China and save us all. But equally, we know they're not investing the cash. And in fact, they're holding such cash reserves that their real value is being discounted by virtue of the very low discount rates. So in a sense, they hold cash, but its real value is declining because it's uncommitted. But that says something about actually how we're in the process of shifting expectations, such that we'll be in a position, I don't know, 2 or 3 years' time, that companies will realise the benefit of holding cash in terms of investment programs. That's, we must remember we've not been in this position in living memory. We've not actually had to save the global financial system in living memory. And having saved it, we have few guidelines about what's the transition to the future. But I must say I'm encouraged by announcements to the effect that in the future there will be increasing interest rates, and there is a pathway to be followed. But as I say, there's a lot of uncertainty. It's uncertainty, it's not risk, it's uncertainty. It's about we've not been here before, and how does this work? And how do we get to a future? We don't know really how we get to the future except by small steps at a time. That's where we are. I think harmonisation of institutions across Europe is a bet on the success or otherwise of one kind of institution. And that's, I think, a ridiculous thing to do. I think one mode of regulation on financial institutions carries with it the risk of being wrong, or worse, institutionalising low growth for the foreseeable future. So I think that's a problem. But, you know, this is what a British citizen would say, because I do think there are dangers in one model or one size fits all of an institution. And, you know, again, we've not been in this space before, actually, where harmonisation has occurred around one type of institution, one institutional form, over such a short period of time. People often talk to me about the United States and say, that's the model. That's how we should look. You know, we have a common regulatory framework, sort of federal institutions that sort of underwrite whole types of institutions. Yeah, but that took 150 years. But what we're doing in Europe is trying to get there in the space of, what, 10 to 25 years. And I think the US still has a diversity of institutions. It still has diversity of regulatory frameworks once you take into account states. And I think that's helpful. So I'm not in favour. I'm neither in favour of the euro, nor am I in favour of the ECB, nor am I in favour of one model fits all. Now, would I have said that 5 years ago? Probably not. But I think the evidence is in front of us that actually the euro, currency integration, ECB are a huge experiment in other people's futures. The costs and consequences of the euro, currency integration, ECB, the costs and consequences of that are borne at the moment by the margins of Europe. And the margins of Europe are in desperate straits. And who I don't see any optimistic growth prospects for Europe as a whole. So, you know, here we are, we're in the midst of this huge experiment of financial and currency integration, and there's no way out, as far as we can see. I certainly don't think that we should pursue further institutional or financial integration. I think we ought to take a big pause and wait 5 years before we go down that path any further. Now, I would not have said this 5 years ago. I think the debate over who should be the next president of the European Commission puts the issue very starkly. And it's notable, actually, that the margins of Europe are silent on the issue because they're politically disenfranchised because of their economic and political collapse. But when you have Scandinavia raising doubts about further centralisation around a president who would pursue the centralisation agenda, says to me that actually there's anxieties at play. And it's interesting to read the debates in Germany. You know, German debate on this issue is really quite deep and vociferous, and it is not the case that Germans in general and in total are necessarily pro-Euro or indeed further integration. It may be the case that the current Chancellor is, but I think she's of a certain generation from a certain region that saw favour in it, regardless of its financial and economic consequences. I do think there are new realities, new geopolitical realities that ought to be taken seriously. But curiously, I don't think those realities are within Europe. I think it's about Europe in relation to Russia, Europe in relation to China. And I think the really threatening moment at the moment in terms of geopolitics is Russia in relation to Germany, in relation to Central and Eastern Europe. And I think that actually suggests that the European project has to develop into a political and dare I say, a defence come military project. And I think that's actually key to Europe's success and survival. So I think it's less about actually economics and finance at the moment. And I think governments ought to be investing more in the common defensive project and seeing in NATO a shell in which actually the European project could be in part redefined. Not that I think that the Russians have that depth of capabilities and resources that, you know, they're not an existential threat to Europe. But I've been surprised even talking to Russians in the UK and even in Oxford about the kind of virulent nationalism that Putin has tapped into. So, I think these are significant issues, not taken seriously enough, deflected by the project of currency integration and economic integration and let's take a pause and look at the defensive question and see in that actually a way of joining together. And I think giving Germany actually and France more authoritative power on the military side of things, paradoxically, than people might have trusted them with, 25 years ago. That's where I think actually the European project lies. When I go out to Greece, when I go to the margins of Europe, they look to Europe not for its economics, they look to Europe for defence, for protection. That has to be taken seriously. But paradoxically, actually, Greeks might wonder actually if they're expendable in terms of defence, but not expendable in terms of economics. And I think that's a telling point.